Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding, the #1 value investing podcast in the world. Sitting next to the co-founder, Mr. Geoff Gannon. Jeff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great for everybody else. If you are watching us on YouTube, hit the subscribe button, thumbs this video up. I'm seeing the views go up. I'm loving it. And of course, if you're listening on the podcast side of things, a rating and review goes a very long way. So in today's podcast, we are going to be talking about relative resulting and the good and bad of comparing yourself to the S&P 500. We've been talking a lot lately about, just truly developing this business owner mindset and how we really try to think about a stock from, an actual business and really try to separate being this portfolio manager from really just being a business analyst or a business investor. And I thought it was interesting listening to the Berkshire meeting when Buffett was talking about this, and he's like, we don't trim, we don't buy little, we don't do any of that sort of thing. We really, it's either in, out, and you could tell it the way he thinks about stuff is he really breaks down the business and thinks about it as a real business. If he's buying one share, he feels like he's buying the whole business. And I think that's a very good tenet to have as an investor. And sometimes there comes this, I guess you could say, disparity or whatever. It gets a lot more challenging when you are constantly benchmarking yourself to the S&P 500, and everybody uses the S&P 500 for the most part.
Okay.
So I think it just almost becomes this thing where it's what everybody sort of obsesses over. Right. But let's talk about your thoughts on it, the good and bad of it. Is there any good? I have no idea.
Yeah.
There are. But, what are your thoughts on it? And let's kind of go from there.
Okay. So, and we use the term resulting because this is a question someone had read Thinking in Bets, which I recommended as a book, and said the only concept they really got from it was this resulting idea, which is the idea of that people think a decision is good or bad because of the results they got from it instead of going and analyzing the decision-making process. So that's the two parts that are the problem here. On an absolute basis, it's already hard to know whether your investment was a good or bad decision, especially over short periods of time. And then on top of that, you're comparing it to the S&P 500, which adds another sort of somewhat random, because it's not perfectly correlated, element to your assessment of your decision. So you'll buy a stock and you'll own it for however many years, and then you'll compare it to the S&P 500 and you'll say, oh, well, I didn't really beat the S&P 500 there, so that was a mistake, that investment, right? I think in the long run, it's good to compare yourself to the S&P 500 potentially because it's helpful for a few different things. One, it's helpful to get an idea of how much of your return is just coming from taking market type risks. That's also, we can talk about beta and all that sort of stuff. And two, I think it's also helpful because it gives you an idea of what you could have gotten if you hadn't managed money yourself. And I think it's a little hard for people, and I would advise not paying any attention to relative results when you first start out. Definitely. So people want to start investing and right away they're after 3 years or something, they think, oh, my results are worse than the S&P 500, then I should stop trying and I should just go into an index fund. And the reality is you kind of have to learn. It's kind of like if they were trying to break into writing or something and they thought, oh, I'll write a novel and I'll compare it to what's out there on the bookshelves. Oh, it's not as good, I'll stop. Not realizing that that's the fifth or sixth one that actually was written by those people. That was the first one that got published, So to some extent, you have to get better too. So I think starting out, it helps a lot to avoid comparing to the S&P 500.
Do you think people should compare themselves to the S&P 500 though, if they're focusing in this micro cap, overlooked space?
Yes, I think everyone should always compare themselves to the S&P 500 because, in my belief, what matters is the opportunity cost. So when we talk to partners in our fund or whatever, the idea is just we want to get you a better result after taxes and fees and all those things, which are not always 100% within our control, but whatever. You should want to get a better result after all that than you would have otherwise gotten in the investment you would have made. I assume the investment they would have made, because we don't want 100 different yardsticks. We need one yardstick, would be the S&P 500. So it's just taking it as an opportunity cost. So I think that's a good measure. It is absolutely true that if you pick a manager focused on one particular area, then when they compare themselves to a particular benchmark, that gives you a better idea of their skill in picking stocks against that benchmark. But I don't know how meaningful that is in the sense of so people will say, well, I would have picked the Russell 2000 or whatever instead of picking you. Okay. Or I would have picked, they can use any sort of composite of things that they make up themselves, and many do. I would just always use the S&P 500 because to me, the things that make the most sense are either you actively take a strategy, which is as unique as you want it to be, which is the sort of thing that we do. It's not, no benchmark would be accurate as a sort of idea of what we do. And in fact, I think that some of the smallest cap indexes are more misleading because of the quality differences in what we buy versus what's in them and stuff. But I think you either pick very active management or you pick like totally passive as your two sorts of things, because otherwise it gets into too many gradations of the yardsticks of what you could use. And then over periods of time, what'll happen is by some measure we'll underperform something and will outperform other things. And that would be true in all periods because of just the luck involved of if you're comparing yourself to 3 or 4 different things instead of one, you will very rarely be the best or the worst among those.
Well, we were actually talking about if you started as a value investor in 2013, 2014, 2015, there is a luck component to it,
right?
Where how many people started then have just gotten taken out on a stretcher.
Right. Yeah. So I was saying that a big part of a money manager's success has to do with what years they started up and what their style is, because you tend to attract a lot of money based on good early performance. And then with too many assets, you don't do as well in later periods. So it tends to be that the best growth investors, the best value investors, whatever, were at a very small size and successful at a period in which it was just a very good time for value. Like I was talking about Peter Cundall or Peter Lynch actually too. Both started off at a time that was pretty good for their sort of style and also started out with really small assets, which they were lucky with. But if Peter Cundall had started in the late 90s, let's say, instead of the pretty early 70s, then I just think that even if he was just as good and even if there were just as many opportunities, because the early few years wouldn't have been impressive, people wouldn't have thought of him as being that great and wouldn't have given him a lot of assets and he wouldn't have become a famous money manager.
Does it seem like a lot of investors that you look at, if they have a record, let's say that's maybe 1 or 2% better than the S&P 500, it really seems like their first 5 or 10 years, they sort of hit it out of the park.
Yes.
And then like the last 5 or 10 years, it's just been like not good. But since they hit it out of the park in the first 5 or 10 years,
right,
they still use that as their performance to show that they've outperformed the S&P 500. But here's why I think that's misleading. It's misleading because their business model is completely different now than it was between those first 1 to 5 years because of the asset size that they are managing.
Yeah, that's the biggest problem. So there's 2 elements to it. One is a luck element. So I will recommend a book that's not out here, or not a book, but an author, Bill James, writes about baseball, doesn't write about investing, but says some very intelligent things about stuff that we can apply to investing stuff. And one of them is the idea that generally the best teams of all time, let's say in baseball, for instance, are both some of the best in terms of their actual skill levels and stuff like that. But then on top of that, they also are the luckiest. And the worst tend to be some of the least skilled, but on top, some of the unluckiest least skilled. In other words, like if you take an average year or something, if a team won 105 games, they might actually have only been of the quality that they should have won, theoretically, based on like their runs. 95 games, right? And then there's 10 games that they won by luck. Whereas the bottom team is more likely to have 10 games that they lost by luck. Still the case that the best team is way better than the worst team. Mm-hmm. But it's also true that the win-loss record for them is skewed a little by luck. Same thing could be true for pitchers and things like that. So same idea applies to portfolio managers, right? Early on, if you're a bit unlucky, you're less likely then to get assets and to grow. And if you are the one who grew the assets the most and everything, there's a tendency for you to have been a bit lucky. So there is a reversion to the mean thing. But the much bigger thing generally is asset growth. And that's the problem. And when I mentioned Peter Cundall, the thing that was sort of really lucky for him, although kind of depressing, I'm sure, for him, is in his first 2 years or so, he had these amazing returns. I forget if it was 30% up, or first 3 years or something might have been 30% or more up annualized, and pretty strong each and every year. And after that period, he had the exact same assets under management as when he started, because the redemptions, because the fund he took over had been like a poor performing fund and the market wasn't doing well and stuff, as people probably they said, oh, I got even. They took their money out of the market, And so because of that, he ended up with the same assets. And then it was very possible to grow a lot. So in a way, that's very lucky, because the worst thing that can happen to you is that your assets grow a lot And unfortunately for money managers, of course, they have money come in beyond the money they're compounding. So, and you tend to have both happen at the same time.
So can you explain that?
Right. So let's say you're managing $10 million. It's very possible with a fund that they could go from 10 million to 20 million because they went up 100% over 3 years, let's say. But then on top of that, they get inflows of 20 million. So now they're managing a $40 million fund. Now that's fine. 10 to 40 million is not such a big difference. Like I can say with the stuff that we do, for instance, some things, if we were 10 times the size, would be a detriment. Definitely. But there are a few things that would be positive because you could buy like more shares and have more votes and things in some companies. However, 100 times our size, there'd be no question. It would just be a detriment. And Buffett talked about this in his partnership letters. Early on, he says like up to a point, there's some benefits to added size, and you know there's economies of scale on the expense side and stuff, and there's some disadvantages. But you do reach a point in which it's just in the investment business diseconomies of scale for performance, for stock picking. Now there are economies of scale for cost stuff. So if you're an index fund, bigger and bigger is always better. But if you're an active manager, smaller is better. Always. Once you cross certain thresholds, and you can compare that. It's the same way, like in businesses, like breweries, as they get bigger, can keep having economies of scale that grow a lot. The economies of scale for a vineyard are realized very quickly. So, like having a somewhat bigger vineyard than another one is helpful, but having the world's biggest vineyard doesn't help that much. Whereas having a giant brewery does help a lot, and it works like that in investing. Unfortunately, the economies of scale for a stock picker are realized very quickly. So, like, someone managing $10 billion is a big disadvantage to someone managing $100 million. And the unfortunate thing is there are many people whose records were based on much smaller amounts.
Well, that's my point.
Yeah.
So it's like you're almost comparing apples to elephants.
Right.
And they're
exactly.
able to still raise money or still, say, well, over time, the past 20 years, we've actually beaten the S&P 500 by X. But if you look at the last 5, 10, 15 years, sometimes they've drastically underperformed. And I just don't know if that argument holds up because how different their business model is because their asset base is so different now than when they first started out.
Right. Like I was thinking about that with Pabrai. I think he's managing somewhat similar to like 10 years ago, but it's a lot less. He was managing a lot less in his first 10 years, which was an amazing period.
Yeah.
Now, his record over the last 10 years or so that I can tell is not very bad for a value manager. However, his early record's based on a smaller asset base. But in that case, I don't know because he has a very concentrated portfolio, which offsets that to a significant extent. If you had a less concentrated portfolio, it becomes more difficult. But even something like Peter Kundal, he was very concentrated early on and had to become less concentrated as time went on, which if you like, that's one of the lessons from reading the book, I think, is the problems that the assets created over time. By the last years of his career, his performance just wasn't that good, which was when most people would have been putting money in with him. And his performance was amazing in the first 10 years.
So for the individuals listening that maybe they outsource some of their capital to other managers, what are some things that you would focus on? So let's talk about the good of comparing yourself and benchmarking yourself to the S&P 500. What are some things that you would focus on if you were going to outsource your capital to somebody else?
Okay, the first is I would try to evaluate their portfolio and their decision-making and their investment philosophy independent of the performance with the S&P 500. So, in fact, some people have asked sort of about like what funds to put things in and stuff. And the truthful answer, and I'll be careful about this because I know we have some people who do open-end funds and stuff who listen to our, not that they invest in them. I'm sure we have many that invest in them, but some who manage them.
Yeah.
But I think closed-end funds make more sense. I don't think there's any reason for someone to choose an open-end fund versus a closed-end, because the reason for that is what happens in the market. So closed-end, you have to buy and sell from other people. And so what happens in the market is that as the type of investments that they make are popular, they tend to trade at a premium, which gets put on top of the fact that the stocks that they like are a premium too. So you get a doubling of the premium. There's a net asset value premium or discount. They actually can become a premium at sometimes in that extreme moment. And at that same moment, those stocks are overvalued too. So you get a doubling of that. On the other side, you get the discount. And so what that means is that if you are in like value type stocks, say you're in emerging market, small cap value or something, you could actually have a discount in your closed-end fund, but that's also the asset class that's really cheap right now. So you end up buying something that gets a closing of the discount, plus that method of investing probably comes into favor. So it makes sense to look at the results over a long period of time. I would say 10 years. I think 10 years is enough, but only against people who are making the same sorts of investments that they are. And then if they're tracking after fees at a similar result. So like, let's say they're small cap value or something, and their result is about the same as small cap value. The fact that they underperform the S&P 500, I wouldn't worry about at all. I think it's a plus to invest in the thing that's out of favor over the last 10 years, and a plus definitely to invest in something that's at a discount versus something that's at not at a discount, because that adds a lot. You can do the math on it, but it adds a lot to your returns over time. So the closing of the discount, even partially. So it's very hard to argue that you would do better in a fund that doesn't sell at a discount than one that does.
Mm-hmm. Now, why do you think the S&P 500 is a good measurement? Because how much of the market has been, I mean, you see the studies, how much of the market is, representative of 5 or 6 stocks,
I don't think it is a good
performance.
Yeah, I don't think it is a good one. So in terms of opportunity costs, I use it. I think it's harder than what the reality is. So the vast majority of people I talk to, if they invested their own money entirely themselves, would underperform the S&P 500 by a lot. Mm-hmm. The best thing that mutual funds do, to the extent that people use mutual funds or index funds, is it just protects people from having much worse performance than the S&P 500 or than the market. So it protects them from having very bad performance versus professionals and people who are better at investing than they are. That's the big benefit to it. I think that in terms of like the S&P 500, something I've said this before, I see no advantage in, say, buying the S&P 500 index fund versus like a Vanguard fund versus actually just buying the same amount of
all the stocks
and never touching it. Because obviously if you did that, your expenses can't be higher. There's mixed results in terms of different time periods of whether buying everything and keeping it worked better or worse, but there's certainly no evidence that it tends to work worse over time, like consistently. So you can see things that compare, like buying the Dow at certain points. Ben Graham wrote about it and stuff at times, and just actually buying those 30 stocks and keeping them. So I don't think indexing actually serves much of a purpose, except that it is something that people will do and otherwise wouldn't. So people won't just buy every stock. So take the Dow. People won't just put 3% or so of their money right now into each of the Dow stocks and keep it forever. But they will hold a Dow index fund for whatever reason. But on the other hand, of course, there are these ETF things that are index, and people use them for a totally different reason. And so that makes them, it doesn't matter what their fees are. People will lose money on them because they'll use them as speculative vehicles, and they'll lose money, which is far in excess of like the expenses on them. The expenses become not that big a factor,
So then you said that you don't think individuals, because a lot of listeners are individual investors themselves, they should not focus on relative results. So you're saying that they should really focus on the absolute results of their performance, right? Of their accounts.
Well, yes, I think it's fine to focus on relative results versus a thing that you can identify ahead of time that you could have done that's easy and you could have stuck with over a long period of time. So I think it's okay to compare your results that you get versus the S&P 500 over 10 years or something. I think that's perfectly fine and good if you identify it ahead of time. I think it's very important. And that's why I say the S&P 500, it's very simple. It's one thing. Right now, let's say you were comparing yourself to the S&P 500 or the Dow and couldn't decide. Well, for the last few months, your result is probably, it depends, but your result is very likely to be better than the Dow and worse than the S&P 500. They're quite different results from the two things. So I think that over short periods of time, it's not that helpful, and you have to identify it yourself. I also don't know how much it matters, because you could also just assume, like, can I beat 10% a year or something over the very long term? So like the S&P 500 in this millennium has not done anywhere near that well because it was very high priced to start off. That's the big problem that it had. But over time, you might want to compare yourself more to that. But then, of course, if we have lots of inflation or don't have any inflation or whatever, it does skew those things a little bit.
So Buffett and Munger, they always talk about the returns of a stock price over time should approximate the returns that the business is generating. So I guess to sort of think about, let's reverse engineer. Let's say you want to do more than 10% per year.
Okay.
Are you automatically disqualifying companies that earn less than returns of like 10% return on equity or 10% return on capital of some sort? Are you just looking to focus on, higher ones, or is it not the case because you want to, or because you also get a return from the multiple expansion in the stock? I mean, how do you typically think about that?
Yeah, either method works. So you could invest in things that are higher quality, that you believe to stay higher quality, but that are not overpriced. Or you could focus on things that are cheap, but you have to do the math. So we can do the math using the 10% thing. So using the 10% thing, let's think. So to have a stock double over 10 years would get us about a 7% return or so, from which should be enough, because if we want to do 10% or better, let's assume that it could take 10 years for our multiple to double, and then we have inflation. We'll assume inflation is like 3%. So this stock can keep up with inflation. It should really do at least better than that if it's reinvesting and its returns on capital aren't going down. So you are almost certain to beat the market if you buy something, or not beat the market, but at least get a 10% return over 10 years. If you buy something that's selling at half of what it's worth, and then it will sell at all of what it's worth, and that will happen within 10 years. Now, Graham said it usually happens in his experience within like 1 to 3 years, 1.5 to 2.5 years, he said. And I've found that to be true.
Greenblatt said the same thing.
Yeah, 1 to 3 years tends to be when it happens. But let's say it takes longer. And the more complicated companies and the faster growers and things like that actually can stay undervalued for a long time. But if you're buying something very static, it does tend to happen a little bit faster than that. So what that would mean is, let's say you find a bank that you like that should trade at least 1 times book, and you buy it at half of book. That's all you need to do, because you will get a return of better than 10% a year if you keep finding that situation and turning it over, finding it and turning it over. We mentioned Maui land and pineapple, for example. Same sort of thing. If you buy something at $400,000 an acre that's worth $1 million an acre, as long as that value gap closes within 10 years or less, then obviously you've just gotten your 10% return just from that, without any increase in the value of the land, because it's more than 7% a year. So you can do that, and we do that in some stocks, I would say. So we've talked about that before in some stocks where we do that. And then we expect some return on top of that. Usually we try not to buy things that are just very cheap, though. So we try to get it from a few different factors working together.
So what do you mean by that? What do you mean you try to buy things that are not that cheap?
So you talked on the rundown about that we owned Vertu Motors.
Geoff watches the rundown. All right.
that we own Vertu Motors. So Vertu Motors, we can use that as an example. So what does it need to do to clear a hurdle of like 10% or better? So a few things. One, we took accounts which were in dollars generally to buy pounds, which I figured over a long period of time would have a gain just from that. And in fact, some of the purchases were made at a very low point for that. So they've already had meaningful gains from that. And that's big, because if the currencies adjust over a period of 10 years or something, an adjustment of that size of, let's say, 30% or whatever the difference in valuation might be from what I think the pound's worth versus what it trades at, is meaningful. You know, it's several percent a year. If it happened in 3 years or something, it would be a lot faster, right? So that's one factor. Then you have the factor of price to book ratio of the stock, price to tangible book.
Yeah.
And the purchases were generally made at about half of what I think others would pay for the entire dealer group. So like in a purchase of one of the top 5 or so biggest dealers in the UK of another would probably, I think, pay in the neighborhood of 1.2 times book value or something, over the long period of time of what happened before. None of them in the market have traded anywhere near that since the Brexit vote. So once it was clear that Brexit was going to happen, or was a possibility Brexit was going to happen, they've not traded at those levels. But still, you don't generally buy dealerships at discounts of 40%, 50%, 60%, and yet stocks were trading at that, right? Then so you can get a return from that. That return alone, as we said, could easily be 7% or more a year. In fact, if it closes, that gap closes in 2-3 years, it can be like 30% a year or something. But you can get returns of 10% just from that sort of thing. The stock was paying a dividend. And the dividend yield was well over 5% at the time and stuff. So if it had continued to pay that dividend, but COVID happened, then you would have gotten a return from that. On top of that, you also have, and again, this is defeated by COVID, capitalization, right? So the other factor that I took into account is that I thought that they were overly capitalized. And this is often when I make a purchase, what the situation is. If a company could have, let's say, 3 times debt to EBITDA or something, a lot of people will like to buy that thing that has that leverage, figuring it'll keep happening and stuff. I prefer to buy the thing that has 1 times EBITDA in cash, but is just as capable as all the other businesses of going to 3 times, because there's a chance while you own the stock, if they want to do some sort of capital allocation to acquire something or whatever, that it'll be to up the debt.
Leverage up.
Right. So instead, we won't get the benefit of that in Vertu, but the upside, on that is that all their other competitors might issue stock, and presumably they won't because they'll have been in a better position in terms of debt. So it turned out to just be a protection, but so you factor all those together and you take them as factors.
And you have like three things.
Right. And when I take that as factors, you'd be surprised sometimes when I say, oh, we could make some money on the currency. Oh, we could make some money by collecting dividend in time. Book value could go up by almost the rate that the industry grows or whatever. Plus, we get a doubling of the book value multiple. Plus, they could increase their debt so that their total assets, their balance sheet grows even more than like the book value. So when you factor all those things together in a row like that, all of them going for you, the number that I get over a 10-year period, and it could happen a lot faster than 10-year, can be really surprising to people. So that number actually is, to me, if that had all gone well, and it didn't, you had COVID, but if it had all gone well, is a far better return than you could get in any growth stock over 10 years. Because you just have to do the math that I said. Like, okay, so you make several percent a year on a dividend, you make several percent a year on currency, you make 7% or more on book value increase, and then you also leverage up and stuff. You do all that and you get numbers that are just way bigger than FANG type stocks and stuff when you look out 10 years.
Now, what about somebody would say, well, are you taking like the NPV of these numbers or something like that,
Right. Yeah, no, I don't. I just draw a line from 2 points and do a calculation on that way. And I figure if the points are far enough apart, then it'll approximate it. I suggest using no shorter than 3 years and no longer than 15. Meaning that no matter how great a company you think you're looking at, imagine you sell it in 15 years. It'll help you from getting a weird DCF result. I admit that some companies continue to perform really well after 15-year holdings. And then on 3 years, I always tell people, do not calculate your value stocks as if you know that they'll reach fair value within less than 3 years. Always assume you have to hold for at least 3 years. You read all these things where write-ups where they say next year,
like Value
it'll get back
Club
to,
and
right. I agree with that. If a net goes to net current asset value or higher or whatever in 1 year, you'll make a 50% something return. And I've done that and it works out. But it's like what Graham said, it could take 1 year, it could take 3. Always assume 3.
Cool. Well, I want to thank everybody so much for tuning in with Mr. Geoff and myself on the Focus Compounding podcast. If this is the first time you're tuning in, hit that subscribe button, thumbs this video up, leave us a rating review on the podcast side of things. If you want to use the software that we use every single day to pull historical financial information, go to quickfs.net. If you sign up, it's $35 a month. And make sure you tell them in the survey afterwards that you came from Focus Compounding. We are very appreciative of all of the support. I want to thank everybody so much for tuning in, and we will see you in the next podcast.